From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for November 28th, 2025. Well, our Milwaukee Bucks host the Knicks tonight and the Brooklyn Nets on Saturday. And as far as Christmas season is concerned and their festivities, get yourself a map of Wisconsin and throw a dart at it. You'll always hit a holiday event. All right, a 10-year-old Tennessee boy drove himself home from school. That's right, he drove himself home from school at 10. He had a disagreement with his mom. The police officers met the concerned mom at the school. She informed the police that her child and car were gone. After imagining the worst, the kid was found at home in front of the TV and the car neatly parked in the garage. Again, he's 10 years old. I have this message for the parents. The next 8 years are going to be a blast. Still, an AI-enabled plush teddy bear have been suspended as it was found that it engaged in conversation around sexually explicit topics and offered potentially dangerous advice. So who's taking sex advice from a talking toy teddy bear? And finally, a baseball card collector bought a wooden chest for $75. Inside, there were 122 rare baseball cards from 1909, 1910, and 1911. He decided to sell the chest and the cards as a set. The final winning bid was $100,000. It's believed the collection would have been worth millions if only they weren't glued to the cabinet.
Ooh.
But $100,000 for a $75 investment is a pretty good return. On the podcast today, we have Art Rothschild, Steve Giles, Joel Driesang, and here with a special edition of Money Talk is Kyle Tedding.
And a very special edition it is, Max. Such an important thing that we like to cover every year on the Thanksgiving week. The role that we can help all of our investors, all of our clients, all of our listeners play in how they support those things most important to them. And so as we do every year, as has become our tradition, we want to spend some time just talking about giving. And as always, we'll start with the reminder that we are not tax advisors. We're investment people. And so you should certainly go out and talk to your tax preparer, your CPA, about how these things impact your specific tax situation. But I do want to be clear that no matter how it impacts you from a tax perspective, the type of giving that we're going to be talking about is a much bigger benefit to you and to those organizations than beyond just the taxes. Of course, one of the easiest ways to give is just to hand over a check to those charitable organizations that you care most about. And again, I think for small gifts and for pretty straightforward scenarios, that can be a good way just to see some of those organizations enriched. It isn't necessarily the way that we're going to get the most tax advantage. And one of the ways that we can give more is to get some tax benefit for those things we are giving, to preserve some of the otherwise taxable assets or assets that would otherwise be exposed to tax, allows us to have more overall to give. And so I think while that is certainly a way that we can start the conversation, especially when we're talking about larger gifts or gifts in which there might be other ways to do it, there are some better ways to get there, Art, and perhaps one of them is to look at those securities within our investment accounts and specifically our taxable accounts and figure out if there's a way we might be able to give those directly to charity.
Yeah, there's a number of benefits come from giving. I mean, it feels good to give money to a charity that you know is going to benefit from having the extra resources, but it also helps your portfolio. Let's assume you have $100,000 of a particular stock that you paid $50,000 for at some point in time. It's gone up in value. If you sell it and give the cash to charity, that doesn't make a lot of sense, even if you're paying a lower capital gains rate. So if you give appreciated property, to charity, then you get a tax deduction. They get the benefit of the value. You also can modify your portfolio in different ways. It's getting rid of something perhaps that you've wanted to get rid of that's gone up in value. So that's a good use. And furthermore, you'll remove the income that you were otherwise deriving from having that asset in your portfolio. So you're reducing your taxes on an annual basis just from not having that income. So that's just a few ideas.
Are there ever dangers of people being, tax wise and investment foolish, where they're trying to look for tax breaks and there's actually a better way for them, for their portfolio, to be giving money away?
Yeah, I think there certainly are, Joel. I always start the conversation with clients on charitable giving by saying we don't ever give away money to save on taxes. We give away the money that we would otherwise want to give to charity, but where we're giving, we want to do it in the most tax-efficient way possible. And so, Art points out the gifts of those highly appreciated assets, making sure that the charitable organizations can receive those securities, that they liquidate them right away so that they have those assets, rather than some security that they maybe don't want to hold long term. But for clients, especially those clients that are entering those RMD, required minimum distribution ages from their IRAs, there can be an even more tax advantageous way to get there. Steve, I know you work with clients all the time on how they navigate their required distributions, how they navigate their IRA in a way that might give them the ability to give to charity as well.
Yeah, so when you attain the age of 70 and a half, Kyle, you are eligible to donate monies directly from your IRA retirement account to charities, so long as it doesn't pass through your hands first. You got to cut the check to the charity. And there are limits as well. You can't donate more than $108,000 this year. The limit does go up next year to $111,000. This can be used to help offset your required minimum distribution. I know a lot of people that have IRAs, they have required minimum distributions that they need to satisfy, but they really don't need the income. They might have a pension, they might have enough money from Social Security, they might be drawing cash flow from other places and other sources, and the required minimum distribution might just be a taxable event that they don't want to incur. So setting up what's called a qualified charitable donation, this QCD right from their IRA to those charitable organizations, is a great way to feel good about contributing back to organizations that you want to support and do it in a very tax-efficient manner. I also know that there are a lot of organizations out there who have made it a push to make beneficiaries part of your estate planning. Know that you do not have to list your kids. Of course, I gotta be careful how I say this here, you guys, but you can assign whoever you want to on your IRA. Obviously, Wisconsin is a marital property state. You must list your spouse as your primary beneficiary, but we're talking about contingent beneficiaries. Should something happen to you and your spouse, most people list their kids. Well, if you don't have kids, or if you want to help an organization that you believe in, you can list those charities to receive a part of your IRA, and they will be more than happy to give you the information on how to get them that money when you're not around anymore. Another way, Kyle, that you can you give money to charities from your IRA is to make sure that when you're donating the money, you're doing so directly to the IRA, either from a check that you have cut to the charity or a check that you write yourself, and we can help you with that. Just contact us and let us know what you need to do.
Yeah, such an important point that in order to exclude the income from that IRA distribution, it does have to go directly to the charity. It cannot be received into your checking account and then you turn around and write a check. Certainly you'd qualify for an itemized deduction potentially in that case, but you want to make sure that that check goes directly to charity, because now it gets excluded entirely from income that you would otherwise have show up on your 1040. The IRS has created a whole new reporting code for these distributions that many of you are going to start to see, ask questions about. They have made it completely optional for custodians who do your tax reporting to fill in that box this year. It was far too late in the year to make it a requirement. And so as you look into kind of tax filing after doing these kinds of gifts, it can get a little confusing. Make sure that you understand you have good receipts. We've seen the state of Wisconsin now auditing some of these charitable gifts. That shouldn't at all discourage you from doing it, but it does mean you want to make sure you have good receipts when we do that kind of stuff. I think that there is certainly no shortage of wonderful places to give. And we do get that question sometimes of, do you have any suggestions for me? We don't want to dictate to you how to give your money, where to give your money. We just want to give you the options. But certainly there are good resources out there for that as we look at kind of what the right places to give are. And we can help you research, at least if you have a particular thought in mind on where do I want to give, we can give you some suggestions there.
And Kyle, we'll have some links as part of the podcast notes for this giving podcast of organizations that you can go to help check out charities. Of course, start with what you know and who you know, but sometimes even if you're solicited by a legitimate charity, you want to check it out. You want to make sure. Bob taught me long ago that even when you're giving money away, that you want to be sure that you're giving it to a place that it's going to be beneficial, that they're being wise with your dollars.
I want to come back to the question that Joel brought up earlier. How do you decide really what to do to a certain extent? It's not only where the money is going to go, but which, now we've got two different ways. We can either give appreciated property or we can do a qualified charitable distribution if you're 70 and a half or older, and if you give away up to $108,000, this year doing that. And so talk with us. We'll guide you, but we're not tax advisors. Talk to your accountant if you want other input. But this QCD thing, since I'm old enough to do this, it's really my favorite way to give money away. I get a checkbook, I write checks. The only thing you have to watch out for is the check has to clear by the end of the year, or it's not going to count toward qualifying for paying off that minimum distribution. Now you can leverage that a little bit if you want it. If you've done all your minimum distribution for a particular year, write those checks either later in the year, make sure they don't clear till the next year, or just wait till early the next year. So it's a wonderful way to give pre-tax money away. So instead of paying tax on money coming out of your IRA, you're giving it to charity. And so it inflates the value of the contribution to a certain extent.
So you have to communicate with that charity to say, hey, make sure you cash this before the end of the year. But you have to do that when you're giving away appreciated property too, right? To make sure that they sell it right away.
We want to make sure that when we are delivering those securities to a charity, that they don't just sit in the charity's investment account. So you're going to reach out to the charity and say, hey, I've gifted you these shares. And you may want to go talk to your broker about selling them, because at the end of the day, if you give $100,000 worth of a stock and then the stock is down 20% the next day, well, the charity was expecting $100,000. Now there's only $80,000 there. And so the charities generally are not in the business of investing. They're in the business of taking care of people, taking care of things, and that's the whole point of the gift. And so it is important that they know that they're on the hook for the receipt of this gift and that they want to make sure they take action in the account.
I think it's worth interjecting here that I get a lot of questions from clients about how they can make gifts to family, kids, relatives, loved ones. You can certainly gift highly appreciated assets to anyone. And when you gift them, they take on the basis. When they sell it, they'll pay the tax at their tax bracket. But you cannot give a charitable donation from your IRA to a relative and have it be counted as a qualified charitable donation. If you give a check from your IRA to your kid and they cash it, you're going to be taxed on that distribution. It is a distribution. For those of you wondering, the gift limits for individuals this year of any kind of whether it's monetary or stock or property is $19,000. Keep in mind that is per individual, per donor. So if you have a situation of a husband and wife together, they can give $38,000 to a child, 19 essentially coming from each of them. The record keeping is pretty simple, but keep track of it. You'll want to make sure that you account for it when you file your tax return. And if you go over that limit, you're going to have to file some other special forms and keep track of your gift tax exclusion for your estate planning.
Yeah, and it's not a limit on what you can give, as you just pointed out. It's a limit on when you have to file a gift tax return. So you have to tell your accountant that you gave away, if you're giving a kid $50,000, it's not going to cost you anything tax-wise. It's not going to cost the kid anything tax-wise. But you should also look at the income tax ramifications. So you're transferring a security with a lower cost basis, as you mentioned. If the child then sells it, there's a gain, and there's something called the kiddie tax. So depending on the age of the beneficiary, assuming it's a child, it will be taxed to that child's parent or at their rates if it's over like $1,750 or something like that. So if they turn around and sell it. So you're getting income off of your return, you're putting it on the kids or potentially the kids' parents' returns. And then for those who are going to college, I had a discussion with this earlier, and they have to file a FAFSA form. Now this kid may have assets that will count against them, if they were otherwise going to qualify for financial aid. So just you have to consider all these ramifications. I know charity begins in the home, even though you can't get the deduction, but there are ramifications to anything you do with respect to the transfer of property, among family members.
I think such an important reminder that these are very complicated conversations. Yeah, the charitable giving piece of it to the actual 501c3s can be pretty straightforward. It's still important that we have a conversation on maybe the best ways to accomplish that. But the more you get into some of that generational gifting, the generational wealth conversation, the more important it is that we have an understanding not just of you, the original investor, but also the broader family dynamics, because it does pull in the lifetime gift tax exclusions. It does pull in college considerations and the kiddie tax considerations, and this vast trove of potential now issues that can be unlocked. We have to, again, make sure that we're in good conversation with the estate planning team, with the CPA team, because there's just so many things, I think, now that factor into that.
Another thing you can do, and it's really beneficial, is you can encourage your kids to accumulate wealth the right way, by the way you give. So Roth IRAs, for example, if your kids qualify to do Roths, but they don't have the money because they're busy putting food on the table, you can say, look, I'm going to give you this $8,000. I want you to put it into a Roth IRA that'll be there for your future, or to help pay for your kids' educations down the road. You do that for a number of years, you accumulate quite a bit of wealth, and it gives the kids that experience of investing for the long run. So here's a parent then influencing, hopefully, in a positive way, their kids.
One thing we haven't touched on yet, gentlemen, is the idea of a donor-advised fund and the potential of using that in a way where you can donate highly appreciated assets in a big amount and essentially claim a deduction in 1 year for what will be years of future giving. And this all comes back to how we used to file our taxes and whether or not you claimed a much smaller standard deduction or itemized. Now that the standard deduction for joint filers is up to $46,700, I don't know many people that have mortgage interest, that have property taxes, that are making trips to Goodwill that are going to exceed $46,700. If you can front load a donor-advised fund with highly appreciated stock, let's say something you bought for $50,000 that's now worth $100,000, you've given yourself the ability to, one, deduct, and maybe two, donate for 10 years the $10,000 you've been given to the church. And you would control that then through your donor-advised fund that you would set up through a custodian of your choosing. I think there's a lot of companies out there that have some pretty good platforms that we can certainly help point you in the right direction. But the point here is for individuals who have highly appreciated assets that they want to remove from their portfolio, maybe because they recognize the need to diversify or to rebalance, but they don't want to trigger their own tax liability, putting the money into a donor-advised fund gives them a huge, huge, huge tax advantage.
Those donor-advised funds can also be a great tool for individuals who maybe have one really high tax year amidst what's otherwise a fairly low tax rate. And you can essentially say sell a business in a tax year, gift at what would be a much higher tax bracket for yourself, but not have to surrender it to the charity or charities all at once. You can spread out that giving over a little bit of a longer period of time. And so that donor advised fund can be a really powerful tool, Steve, to your point, to front load some of that giving without burdening a charity with a large gift that they otherwise may not be prepared to take on and spend. I know that certainly is part of the conversation is when we are giving to these charities, we want to make sure that it's going toward those things which we know the charities are aimed toward. With that, I think a wonderful time of year to, again, have this conversation We would love to hear from you on how you may want to give, be part of the conversation with you to the extent that you might want our help. We do enjoy doing this program for you, both this one in particular and everyone, and we will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.